So an ETF is an exchange-traded fund. Well, let's break down the words in exchange-traded funds. A fund is a group of assets that is pre-selected and most of the time passively managed by a set of parameters or rules or filters, so to speak. And those holdings are periodically rebalanced or reevaluated to see if they still meet all of the fund's objectives or the rules for inclusion. So, for example, if you have an ETF that follows an index, like let's say the S&P, there's a lot of S&P ETFs out there, and they can be structured in different ways, but they will typically include the holdings that are found in the S&P. So it's a way to sort of buy the index. If you just want to have an unmanaged index, you get the broad diversification of having around 500 different stocks, and the performance tends to follow the market. Well, ETFs are very similar to mutual funds in the way that they are diversified, because in a mutual fund, you can have a lot of different securities. It could be fairly concentrated where you have 20 to 30 holdings, all the way to, very diversified with over, 500 holdings if you're following one of the index funds. ETFs are diversified because with one holding, you can have ownership of many different underlying assets. So they could be stocks, they could be bonds, an ETF could be tied to a commodity such as gold or silver, or oil or any of the other commodities, or, as we found out today and hitting the markets very soon, cryptocurrencies. The value of ETFs are linked to the underlying asset that the ETF owns. So they are different from mutual funds in that they are traded on a stock exchange, and they can be traded all day while the market is open in real time rather than pricing once a day like mutual funds do. Well, what are some of the benefits of an ETF versus a mutual fund? Well, they're a little bit easier to own. You can purchase the shares while the market is open, just like you would an individual stock. Mutual funds, you put in an order and you get whatever price it is on the close of the business day. ETFs, a lot of times, tend to give you a lower cost option to owning the basket of securities that you're looking at. So because most of them are not actively managed like mutual funds are. Mutual funds, since they're actively managed, they have to pay a professional manager to do that. So they have more cost involved with that. ETFs also have certain tax benefits that mutual funds don't. So they were created under two different sets of regulation. Mutual funds must pass their capital gains along to their shareholders every year. So that's why at the end of the year, end of November, December, mutual funds will do a capital gains distribution. So if they have gains during the year, they pass those to their shareholders. ETFs don't have to do that because it's considered to be kind of an exchange of the basket of goods whenever they rebalance their portfolios. So there is a little bit of a tax benefit to using ETFs over mutual funds. So how does an ETF fit into a well-balanced portfolio? Well, an ETF can serve as kind of a foundational piece to a portfolio. You can if you wanted to do, let's just say, a 60-40 split in your portfolio, you could theoretically buy a handful of ETFs, maybe, 3 or 4 ETFs, and have a completely diversified portfolio. You can have many holdings. You can have, within those 3 or 4 different positions, and you can have several different asset classes. So you can achieve diversification quite easily with few holdings. It can also instill confidence in portfolio selection because you do have that professional management piece of it where those securities are professionally selected.